Hey, okay, guys. Let's begin. No time to wait for the latecomers, lah. Mainly because I think tonight market might be a little volatile since we have the Jerome Powell Congress ongoing, right? So, we shall begin. Okay, so the purpose of today's session, right, it is to go through what is volatility, more in-depth, more advanced analysis and assessment of volatility itself. Because during the course material, what you have learned is the ATRP percentage or the average true rank percentage, but that is like a shortcut method. It is serviceable to a certain extent, but the actual volatility measurement, right? We use a statistical method, which is a much more accurate, much more detailed method that is able to give you a lot of information. You have a better understanding of how the stock move, and you will have much more accurate profit and stop loss level. But not only that, when you are dealing with options, right, it allows you to choose option strike much better based on the probability of the volatility itself. So what I have here is the Investopedia, the official definition of what is volatility. So you can see here, it is a statistical measurement of the dispersion of return for a given security or a market index. And in most cases, the higher the volatility, the riskier the security. But they also forgot to mention higher volatility means your profit potential is a lot higher also. So volatility is often measured from either standard deviation or variance between returns from the same security or market index. So you can calculate the volatility via standard deviation or variance, okay? But for our case, right, we are going to use the standard deviation method. It is much simpler to understand, mainly because I believe everyone who is have gone through statistical module during your uni days, poly day, JC days, right, you'll be quite familiar with it, okay? So we'll be dealing with standard deviation, and what we are looking at is the standard deviation of the returns. Returns meaning we are going to look at maybe weekly returns or monthly returns, and we calculate what is the standard deviation like, and then from there we have a very detailed idea of how is the volatility for the stock itself. So I will try to explain the theory portion, and then I will go through the Excel spreadsheet. I will give you an Excel and I'll show you how to use it. And after that, right, I will give you some example of application using options and this volatility assessment, which will give you a much better option structuring. Okay, I don't think we can be done by 10, but maybe we can be done by 10:30. So let's go through a bit on the theory itself. What is dispersion of return? Another term for dispersion of return is also known as the distribution of return, or short form, we will call it the DOR. So when you start to see a lot of DOR Excel coming up, I will post it in the Discord channel, okay? So that for certain trades that we are looking at, you can actually look at the Excel spreadsheet for the distribution of return. Okay, so same thing. This is from Investopedia. So what is a normal distribution? A normal distribution is also known as a Gaussian distribution. It's a probability distribution that is symmetric about the mean, showing that data near the mean are more frequent in occurrence than data far from the mean. So it is your bell-shaped curve, okay? But when we look at normal distribution, right, no matter what kind of data you are looking at, you will usually get this kind of probability. Okay, so the first chart that you see here, this is your first standard deviation. Your 0 is your mean, okay? Then you have the +1 standard deviation and -1 standard deviation. They write wrongly, okay? This one should be -1. This one should be -2. So for data that are within +1 and -1 standard deviation, right, it will occur 68% of the time, no matter what kind of data you are looking at. And data that are between plus 2 and minus 2 standard deviation, it will occur 95% of the time, the shaded area within the graph, okay? Meaning it will also include the standard deviation 1, okay? The plus and minus 1 standard deviation 1, it is included in the 95%. But if you want to calculate what is the probability of data occurring between standard deviation 1 and standard deviation 2, and then standard deviation -1 and standard deviation -2, right? Then you have to 95 minus the 68, which you can see here, it occurs 27% of the time for data that are falling between 1 standard deviation and 2 standard deviation, okay? And then lastly, we have the 3 standard deviation. So 99.7% of the time, right, your data will fall between +3 and -3 standard deviation. So if you just want to look at this little portion here, meaning data that are falling between standard deviation 2 and standard deviation 3, right, then what you have to do is you have to minus 99.7 minus 95, then you will get about 4.7%, meaning only 4.7% of the time your data will fall between the standard 2 and standard 3 deviation. And anything outside of standard deviation 3, right, it only occurs 0.3% of the time, meaning very, very rare, okay? You do get some amount of occurrence, but it is quite rare. So if you look at your own returns, your asset returns, right? For example, if you are monitoring your monthly return on your trading journal, it is highly likely that it will fall within this normal distribution as well, provided that you have sufficient data, okay? Meaning you have been trading for like 4 or 5 years. If you collate all your data in a monthly return format, right? Most of the time you will get a normal distribution curve. So now let's take a look at an example. This is a deviation distribution or return for Apple. You will see a lot of numbers here, but I will try to go through every single one of them. So for Apple, right, what you are seeing here is, excuse me, is the data for monthly return. Okay, it is monthly, meaning within 1 month to 1 month, how much Apple performance is. How is Apple performance like from a month to month closing, the closing price month to month. So if you look at the standard deviation, right? So for standard deviation 1, the upper bound and the lower bound is 14.7% to -10%. Meaning you can see this is the bell-shaped curve. So your standard deviation 1 is somewhere around here, 14. And the lower bound is -10. -10 is probably somewhere around here, okay? So that is your standard deviation 1. And you can see that that I have a total of 456 count, meaning I have 456 data points, which means this Apple have a total of 456 monthly data that I can look at. So within this 456 data point, 323 of the month fall between the standard deviation 1, and it account for 70%. So this is the actual count, okay? 70%. And if we look at the theoretical normal distribution count, right, it is 68%. So it is very near, okay? Extremely near. It's off by like maybe 1% plus only, or about 2% plus, okay? So it is extremely, extremely near if we look at the actual data. And then when we look at standard deviation 2, the upper bound is 27.07, which is somewhere around here. And then the lower bound is -22.35, which is somewhere around here. So this is your standard deviation 2. And of course, for standard deviation 2, right, it occurs 433 counts. This is inclusive of the standard deviation 1 also. So if you just want to look at those data that are between standard deviation 1 and standard deviation 2, right, then you have to minus them, okay? But 432 data occurs between standard deviation plus and -2, and it accounts for 94.74% of the data, which is also very close to the theoretical normal distribution count. And lastly, we have the standard deviation 3, which is the upper bound is 39%, which is somewhere around here. 39.42, which is like here. Sorry. And the lower bound is 34. So it's the entire curve, okay? It is the entire curve. And you can see that there's a total of 453 data, meaning to say that 456 minus 453, right? There's actually 3 data points that are outside of the 3 standard deviation range, okay? If we look at all the data within the 3 standard deviation umbrella, it accounts for 99.73% of the data. So from here, right, we can get a little bit of appreciation on how Apple actually moves month to month. So let's look at the descriptive statistic. You can see the mean here. The mean is 2.35%, which is not meaningful at all. Why do I say it is not meaningful is because if we look at month-to-month performance, month-to-month closing, right, we are actually looking at both positive data and negative data, okay? So when we look at both positive and negative data, right, when you take the average, the mean is somewhere around like 0 like that. Somewhere around 0, 1, or 2 like that, which is why the mean is 2.35. So this mean here, it doesn't mean that every month, right, Apple tend to close around 2.35% movement. It doesn't mean like that. But rather, if you want to look at the monthly volatility, what you should be looking at is standard deviation, 12.34%. Meaning on average, your Apple, it will move 12.354. Sorry, on Apple, right, every monthly, it will move about 2.357% plus your standard deviation. If you do that, you will get the upper bound. And if you minus the standard deviation, you will get the lower bound, okay? So we actually look at the standard deviation number. So sample variance, don't need to understand. Kurtosis and skewedness, right? It's not important, but I will go through roughly later, okay? And then you have your maximum and minimum. Maximum meaning what is the highest data that we ever get from this data set? It is 45.378%, meaning there was 1 month where Apple actually moved up 45% within that month itself. And of course, this maximum, it fall outside of your 3 standard deviation range. And same thing for the minimum also. There was 1 month where the Apple actually returned less. Apple actually went down by 57%, which is also outside of your 3 standard deviation rate, outside of the lower bound. Okay. So this range here is referring to your maximum range and the minimum range. So from the lowest point is minus 57. The highest point is plus 45. So what is this whole range? This whole range is 103. Okay. So it's simply these 2 numbers add together, you get 103. So the next is this sum. Sum, I don't really know what is that, but it doesn't matter also, okay? So you don't have to worry about the sum. So now, kurtosis and skewedness, this is just for information only, okay? It doesn't affect our trading. Positive kurtosis means majority of your data point, it fall very close to your mean. Negative kurtosis means the data is very spread apart. So in the case of Apple, right, you do have a positive kurtosis, but this number, I mean, it's very hard to find out how this number actually relate. But this is more towards normal, okay? It falls between the normal range, meaning it is something like the normal distribution like that. It is not overly positive, and it is not going into negative also. But if you have a very negative kurtosis, right, you can see it from the distribution curve itself also. You will see it very flat, okay? Very few occurrence fall within the mean itself. But most of the time, we don't really see that. We actually see majority of the data will fall within the theoretical normal distribution count. And skewedness is, of course, is it skewed towards the positive side or the negative side? But this one have to be careful. Positive skewedness is skewing towards the left-hand side, meaning more data are negative. There are more negative data. And negative skewedness means it is skewing towards the right-hand side, meaning there are more positive data. Okay, so this positive and negative don't mix up. Huh? Okay, so from a graphical presentation, right? I have worked out. You can see where are the first standard deviation 1, 2, and 3 lies. So for standard deviation 1, right, upper bound is 14.71, lower bound is -10, and 70.83% of your data fall within this standard deviation 1, and then so on and so forth. Okay, it is just a graphical presentation of what I have shared earlier. So this is basically what we are trying to do. We are trying to draw a bell-shaped curve. But on top of that, there are a lot of things that we can actually get from. There are a lot of information we can get by drawing this particular chart. Okay, so now that is basically your theory. Let's go straight to the theoretical. So what you will have, right? You will be given this Excel spreadsheet, and I will show you how to use it here. And then we will go through some actual example, okay, with live application based on some of the trade that we may be taking in the future. So this blue shaded area is the part where you need to enter your data. Okay, these are all monthly data. You can see the date, right? It is jumping every month. So it is 1st of January, 1st of February, 1st of March, 1st of April. So for distribution or return, right, unlike average true range, it is better to use monthly, mainly because we are going to be holding the trade for 1 or 2 months. If within 1 or 2 months we cannot get the TP or the trade is not doing well, right, we will get out of the trade already. Okay, so there's no point in looking at weekly for distribution or return, because if we have a weekly data, right, we need to account for like, okay, I need to hold for 4 data set because 4 weeks is like 1 month. So we need to do a lot of analysis, which makes the whole thing very messy. But to be safe, right, just look at monthly data. And a little bit of advice when doing this is you have to be careful, because the distribution of return, we are looking at the past data, meaning the more data the stock have, the more accurate it is, which is why I use Apple as an example, because Apple has been around for very, very long. Meaning to say that if you are trying to use very recent company that just IPO during 2020, right? For example, Zoom, Palantir, Snowflake, CrowdStrike, all these companies, they IPO very recently, okay, in like maybe 2-3 years ago. So if you are doing a monthly distribution of return, right, you probably only have like 36 data point, or maybe if you are lucky, 48 data point, and that's not really sufficient enough. You can still go ahead and do your analysis, but you have to be very careful, because it is highly likely that you will sort of run into certain future price movement where the data points is very often falling outside of your 3 standard deviation, mainly because you have not gotten a proper data set yet. So for most company, right, that you are trying to do distribution or return, it is good that they have gone through several business cycle, meaning they have gone through the housing crisis, they have gone through the 2015 trade war, or the rate hike cycle, make sure that they have gone through multiple business cycle. Okay, so at least from 2015 onwards is fine. I don't think most of the stuff that we are looking at, they are around before the housing crisis 2007. If you have it, then good lah. Okay, but if not, from 2015 is fine. But be very, very mindful of those stocks that recently IPO during the COVID period lah. Okay. So first, what you have to do is you have to delete all the current data here. So don't delete these two, okay? The C2C return and H2L return, don't delete. Just delete the blue color one. On Excel spreadsheet, right, you can just double click this. It will select all the way down, and then I'll just delete now, okay? So just double check there are no data all the way down. And maybe for this one also, I will leave the top two because the top two I can drag down now. Okay, I'll just delete all the bottom data because we don't know how far the data go. So to be safer, right, we just delete everything, and then you can see everything here disappear already. Okay, so next, I'm going to use First Solar because since we have a First Solar trade that have potential trade in the future, right? Let's use First Solar. The place to get your data is Yahoo Finance. You can get it for free. So just type First Solar, FSLR. So once you got First Solar here already, right? You go to historical data. Okay, once you got the historical data, time period, right? You click here, click max. We want every single data. And you can see First Solar is already there since 2006. Okay, so it is a good, we have a good amount of data point. And frequency, right? I want monthly. And then you click apply. And then just double check. Okay, you can see the data are from every month. So you have the open, high, low, close, adjusted close. Adjusted close is adjusting for dividend now, okay? And you can see the latest data is on the June 20th. This is simply because they give you the latest data, okay? But June haven't end yet, but the latest data is there. So just click download and then open up. Okay, once you open up already, you'll get something like this. We don't need the volume, get rid of the volume. Okay, next, right, what we want is we want the earliest data at the top. Okay, so we need to shift around a bit. So you can simply just select this column, go to data, click the filter function. It will create this filter. And then what you do is you click the date, you click newest to oldest, and it will shift all the data, okay? The newest one at the top. But because this latest data, right, the month haven't end yet, so this latest data is not really that accurate, and in fact you can see there is a bit of double entry here, okay? So what we will do is we will delete off the latest data. Okay, then you have data all the way until the latest monthly close, which is your June now, okay? Your June closing. Sorry, the beginning of June data. So in this case, right, after I have done this, what I will do is I will select everything, copy, and then paste here. But when you paste here, right, you paste data, okay? Just paste the value, don't paste the whole thing, just paste the value. Okay, once you paste the value, you will see that this formula, it will auto calculate. And then you just drag the whole formula down all the way until the bottom. So when you are trying to copy and paste a new data on top, right, make sure you delete the old data first because you don't know your new data, the data until where. If your data is only until 2012, right, what you have is you will copy until here, and then the rest of the bottom is from your older data set, and then your information wrong already. Okay, your distribution or return is wrong already. So be very, very careful when you are dealing with this. And once I have scrolled all the way down already, you can see everything is error, okay? And the reason why everything is error is because the last data point, right, this thing present, there's a formula error. The reason why there's formula error is because for this column, right, it is using close to close return. It is calculating previous close to the current close. So it is using back the previous data, okay? But if you go down all the way to the last data set, right, it has no previous data to use. So it gives you a error, formula error. So if you have this here, your chart won't work. So what you do is you simply delete this. And now the chart is normal already. Okay, so what you see here is same thing. It is the exact same thing as Apple. You have the bell-shaped curve here, but there are a lot of additional information you are seeing here. I will go through them, and this is where you will start to sort of use all these data for your trade setups. Okay, now, firstly, I want to explain a little bit on this also. These are close to close, okay? It is looking, if you consider a monthly candle, right? It is looking at the previous candle close to the current candle close, okay? So it is close to close. So we have close to close return. And we also have high to low return. So high to low return is the lowest point of the current candle to the highest point of the current candle. So to show you graphically, right? Let me put up First Solar. Where's my First Solar? Okay, so I'm going to switch to monthly. Okay, so close to close. This candle is June candle. It is still ongoing. So let me just get rid of that candle. Okay, close to close is we are looking at the previous candle close to the next candle close. So be mindful of the candle color, okay? Because if the candle is green, the close is at the bottom. If the candle is red, the close is at the bottom. If the candle is green, then the close is at the top, okay? So in this case here, right, the close to close for this current candle is from the previous closing, which is here, to the current closing, which is here. So this is about 11.6%. Agak-agak lah, okay? 11.6%. Oops, this one which you are seeing here, 11.16. Okay. And then high to low, right? High to low is your candle highest point and the lowest point. So we are looking at the wick to wick, okay? So in this case, the lowest point is here. The highest point is here. So in this case, the high to low is about 35%. Okay, you can see here 35%. Okay, in fact, I should delete this data but since it's already there, we just leave it as that. Wait, if I delete this, how will the data be like? Okay, I think that's better. Okay, so let's take a look at the descriptive first. You can see that the mean will be very near to 0 because as I mentioned, right, if you look at the close to close, right, we have positive numbers and negative numbers. So if you take the average, right, you will usually get to very close to 0, okay? But what you can see is the standard deviation is 17%. If you compare to Apple data just now, Apple standard deviation is 12%. But you can see First Solar definitely a lot more volatile than Apple because we are looking at 17% deviation. And there's a new data here, which is annualized volatility. So based on the monthly standard deviation, right, we can actually sort of calculate what is the yearly volatility like, meaning within 1 year, how much can it move? So it is square root 12 times this number, and then you will get 59.976. So there's a reason why we have to square root 12. You can go and research it because it is statistical stuff. I'm not going to go through that. And this annualized volatility, right? If you look at option pricing tend to have this thing called the implied volatility, okay? Implied volatility means the option market maker is looking at what is the future volatility like. But how will they know what is the future volatility like? Because they are using the past volatility as a guidance. So this annualized volatility is very important also because the higher your annualized volatility, the higher your implied volatility, and the higher your option premium will be. And if we want to talk about the industry standard for volatility, right, we are by default referring to the annualized volatility. Okay, so we can actually double check a bit. So let me just look at the option and let's see what is the implied volatility for First Solar. So you can see here the implied volatility for First Solar is 40.9%, which is in the 3% percentile rank, meaning to say that currently this volatility is considered very low. Okay, the implied volatility is very low, it's at 3% percentile. Meaning 3% of the time IV was lower in the last year than the current level. So if we were to look at it at an average level, maybe 50% percentile, right? Then First Solar IV will probably be around what we have calculated, the annualized volatility around 59%. But currently, I think the market is kind of like looking at First Solar not to have so much volatility going into the future. Okay, but you will sort of see the number is somewhere around there. And for First Solar, you can also see the maximum is 72%, meaning that there was 1 month that it went up like 72%. Minimum is minus 36%, meaning the maximum loss it ever occur for a month is negative 36%. Okay, and you can see the positive data point. There are 102 positive data point and 95 negative data point. And for every positive month, the average return is about 15.46%. For negative months, the average return is about negative 11%. So from this data alone, you can definitely tell that First Solar is in a long-term uptrend. Okay, there are more positive months than negative months. And for the positive months, right, the return is a lot higher compared to the negative months. Okay, so this is close to close. So we are looking at close to close. Okay, the high to low we will settle later. So now you need to understand how to read this table. This table is very important. Okay, so these are the range. Okay, these are the range. This range is referring to your monthly return of First Solar. And this probability is telling you what is the occurrence based on past data. How many times did First Solar achieve these returns? Okay, so frequency, under frequency, right, it will tell you how many months are there where First Solar attained these numbers. So let's take a look at this entire range. For the first one, less than 49.5%. So there were no months, not one at all, where First Solar returned less than 49.5%. So the frequency is 0, probability is 0. How about 39 to 49%? So these are range by range by range. So how many times did First Solar return negative 39 to negative 49? Also 0. Okay, so the probability is 0. And now, how many times did First Solar return negative 28 to negative 39%? There are 5 counts. So it is 5. And the probability is 2.54% because there's a total of 197 counts. If you take the probability 5 over 197, you will get 2.54. Okay, so that's basic calculation. Of course, I mean, you can, if you want to verify, right, you can go and find where are the moments where First Solar achieve this achieve return within this range. Now let's look at the next one. Negative 18 to negative 28%. What is the frequency? So you can see as we get closer to the mean, right, the frequency become higher and higher. So we are moving up this bell-shaped curve, okay? So for negative 18 to negative 28, right, there are a total of 16 counts. So that account for 8% of the data. Okay, so here, right, you will see there is an additional column here called the cumulative percentage, which is 10.66. So this 10.66 is basically adding 8 and 2 lah, okay? You get 10.66. But I mean it's 8, 2.5 and 0 lah, okay? It's just adding up everything that is before. So for example, this 27% is adding up 16.7, 8.1, 2.5, 0. So what is the purpose of cumulative percentage? So if you look at this, right, this data set, it is only accounting for negative 18% to negative 28. But what if I want to know what is the probability of First Solar returning negative 18 and below? Okay, negative 18 and below, meaning it is negative 18 all the way down. So it is essentially adding up the probability lah. Okay, so meaning to say that there is a 10.66 chance that First Solar will return negative 18 or lower. So from here, right, if you set your stop loss as at negative 18%, you will get 10% chance of getting stop out. Okay, because we are looking at negative 18% and below. Okay, so it works the other way around also. So what do I mean by the other way around? What if I want to look at the probability of First Solar returning negative 18 and above? Okay, and above, meaning we are going the other end. Meaning it is not adding this side, but we are adding this side. But you don't need to add all the way here. What you do is 100 minus 8.12, then you will get the amount of data point where First Solar return negative 18.37 and above. Okay, so the above portion, it is meant for you to predict, sort of set your TP level. The below portion is meant for you to set your stop loss level. So at least you get an idea of the probability of you getting stop out. Okay, but if you are looking at short position, everything is terbalik already, okay? Meaning the downside is your return, the upside is your stop loss. So to make sure you are not confused, right? We will go through some live example later. But for now, try learn how to read the data first lah. Okay, so as we move forward, right, you will see the range the range is slowly moving up lah. Okay, so let's skip a few. For 12.79 to 23.18, so we are going towards the positive side already lah. Okay, how many times did First Solar return 12.79%, positive 12.79 to 23.18%? It returned 14% of the time. Okay, but if I want to look at what is the probability of First Solar returning 23.18 and lower, 23.18 or lower, then we look at the cumulative, 88% of the time. Okay, and if I want to look at what is the probability of First Solar returning 23.18 or higher, then we are actually looking at 100 minus 14, which is actually about 85% like that. Okay, so make sure you know how to calculate all this. Okay, and this is the data range. But next, right, we can actually look at the percentile rank also. There's a percentile rank here lah. Okay, so for the percentile rank, right, the bolded one are your percentile, and then the non-bolded one are your returns lah. Okay, so for example, right, let's say if I am looking at negative 22%. So what is the chance, what is the probability of First Solar giving me negative 22 or lower? Okay, so the probability of First Solar giving me negative 22% or lower is actually 7%. So if I set my stop loss 22% down, it means that within the next month, the chances of me hitting that stop loss is 7%. Okay, but remember, this is close to close. So we will go through, we will sort of go through that later lah. And let's say if I want to set my TP level maybe 20% from my entry, 20% upside lah, okay? I'm looking at positive 20% from my entry. So positive 20% is here, okay? So positive 20% is actually at the 87th percentile. But it doesn't mean that you have 87% chance of hitting your TP. It actually means that you have 100 minus 87, which is 13%, meaning within the month, you have 13% chance of getting 20% gain now. Okay, so this is the percentile. So for percentile, right, it is also same. You need to learn when to use the cumulative. You also need to know when to minus 100. If you minus the 100, right, make sure you know which number you are minusing. Okay, so after this lesson, right, try to give it a go. Try to play around with it and see what are the kind of things that you can do with this. Next, this is close to close. So next we are going to look at high to low. Okay, so high to low, right? Holy shit, Rivian Rally. If you are looking at high to low, we are looking at the wick. Okay, so because we are looking at the wick, obviously the range will be a lot higher. Okay, so in this case, you can see the wick itself is about 35%, but the candle body is not a lot. And for most of the time, right, you can see the high to low definitely will be much higher than your close to close. But when we talk about high to low, right, we are actually calculating from the lower side to the higher side, what is the percentage change. Okay, meaning this is a absolute number. We are just looking at high to low. It doesn't matter green candle or red candle. If I'm looking at red candle, it is also same. I'm looking at the low to the high. Red candle, green candle doesn't matter. The high to low percentage is a absolute value. There's no negative, there's no positive. It is just absolute value. Okay, wait, got one question. Let me see. First solar 184 reach indicative. Okay, that one no rush. We tackle that later. let's not get carried away by the market right now. So here, right, it is exactly the same thing, but it is just that we are looking at the high to low. So what is the high to low bell-shaped curve? What is the distribution of return for the high to low? So it is exactly the same thing. It is just that there's no negative, there's no positive number. Okay, but the high to low, it can get very, very crazy. It can go very, very wild because you can see the highest amount, the maximum amount is actually 112%. So within that 1 month, from high to low, right? From low to high, the First Solar actually can move like pretty crazy. Okay, so let's take a look at live example just to look at how to apply all this. Wait, sorry, let me just take a quickie look. Okay, Nasdaq down 16. Okay, sorry. Let me get rid of this. Okay, so now I have First Solar. Currently, the price is moving now. Okay, so currently the price is moving. So you may see the number shift lah. So for First Solar, right, we actually have a long idea. So this is something that we want to go long position on. But let me just mark out all the important price level. Okay. So this is the previous close. So the previous close is 202.96. 202.96. Let me just previous close. Okay, that's the previous close. Then currently we have no close yet because this candle is still moving. June haven't end yet, so I will not show you the current close now, okay? Because the candle is still moving. But we do have the current high. Okay, this is the current high. Okay, then current high is 212.35. Okay, currently we seems like there's a current low here. You can see a bit of wick there, right? So I will put the current low also lah, because the candle is moving, right? It's you just pretend the low is stagnant now, okay? The low is 183.7. 183.7. So this is the current low. Okay, so we have the previous close, current high, current low. Okay, so now let's say we have a trade idea on this. We have a long trade idea. So when we have a long trade idea, right, the first thing you want to set is, of course, the stop loss level. Okay, so where do we want to set the stop loss level? It's very obvious. We want to set below the previous swing point. So from a monthly candle perspective, right? The previous swing points are this level and this level. And let's just go to daily time frame, okay? Let's just go to daily time frame. The swing point is like this one here, okay? This one here and somewhere around this gap here also. Of course, when you are looking to enter, if you are looking at things like your RSI, MACD, the trend candle, right? Definitely you will use the daily time frame now, okay? But since we are working out the distribution of return, the probability, we will use the monthly candle. So let's just put a theoretical stop loss lah. Our theoretical stop loss let's put at 168. Okay, let's put at 168. I will call this the downside target. I'll just call this downside target now. Okay, so this is our downside target. Okay, so our downside target is at 168. Okay, so now let's apply the distribution of return. So because we are looking at close to close, right? We are looking at close to close. So we are looking at previous close to this month close now, okay? Although we still have there's still about maybe 10 more days before today this month candle close now. So from the previous candle, previous close to our stop loss price is about 17% down. Okay, meaning to say that I'm actually looking at what is the probability of First Solar closing at 168 in the current month. Okay, in the current month, meaning the end of June, which is about a few days away now. Okay, so what is the probability? 17.26% down. So let's look at the distribution. 17.26. So we are looking at negative 17.26. Okay, so the closest one we get is actually this one, negative this one actually, negative 18%. Okay, it is the closest to 17%. Okay, so what is the probability of First Solar closing negative 18% or lower? We need to account for those closing lower also. And the probability is 10.66%. Meaning there's a 10.66% chance that within this month, First Solar will close at 168. Close, the keyword is close, okay? Meaning it can just go down and then close back up also, which is possible lah. Okay, so now that is one way you can look at it, but you can actually look at the percentile also, the percentile table. So we are looking at 17% downside from the previous closing. Okay, so 17% downside is somewhere here, 17, this one, okay, this one, 16.91 is the closest. So it is at the 12th percentile rank. meaning to say that there's a 12% chance of First Solar closing at our stop loss this month, okay, end of this month. So this one gives you a much accurate pinpoint of the actual percentage, the actual percentile, mainly because if you are looking at this, right, we're actually looking at a very, very big range now, okay? We're actually looking at all the way from 18.37 all the way to -28. So if we want to look at a much more pinpoint the exact number, right, using the percentile is more accurate, but you will see the number not very far off also. Like in this case here, right, we have 12% chance of our First Solar hitting the stop loss, which is 17% downside. And here, right, it is about 11% chance, 10.66 now. Okay, so it's plus minus 1% like that. Okay, so if you want to place your stop loss there, it's fine, but I mean that is the theoretical, okay, for this month, this month. But since the current price is here, since this is the current price, so I'm just gonna just pretend the current price is fixed now, okay? Okay, so this is the current price. Okay, so now let's calculate from current price. Current price to stop loss. It is 9% down. Okay, so if we are looking at current price to stop loss, right, what are we actually looking at? We are actually looking at 1 month from now. Okay, we are not looking at end of June, but we are looking at 1 month from now, because what the data that we are looking at is monthly data. So 1 month from now, right, 1 month from the date of your entry, what is the probability of your if you enter here, right, if you enter at this current price, what is the probability of you hitting this stop loss? So the downside is 9%, 9% down. So same thing, you can look at this, 9% is somewhere here. So if we look at the cumulative percentage, right, you actually have 27% chance of hitting the stop loss now, okay? But of course, we look at the percentile, it's better. 9% is somewhere here, okay? So yeah, around that, about 25% chance. There's a 25% chance of you hitting stop loss. So the reason why the probability increase is mainly because it is definitely a lot narrower. That's why the probability increase. But it is also because we are looking at current price to your stop loss now. Okay, we are not looking at the previous closing price, because if we look at June, right? If we look at June, there's only 10 more days, and it is highly unlikely that in the next 10 days, right, First Solar can just go all the way down. There is a possible chance, but it is highly unlikely. But if you look at from entry to stop loss, right, we are looking at the entire next 1 month now, okay? We are looking at 1 month forward, mainly because your entry is always like from the day that you enter, okay? Because we didn't enter at the beginning of June. We are entering right now. So we are looking at 1 month from the day of our entry. So that is how you can look at the distribution of return. So there's a 25% chance of you hitting this lah. Okay, but of course these are all probability based on the distribution of return. It doesn't take into account of things like the fundamentals, your technical momentum, all these kind of thing is not put into account lah. Okay, of course, if you have a chart that is trending up, right, then it is highly unlikely. It is the probability of hitting a downside target is a lot more less probable compared to the upside target lah. Okay, so now we look at the close to close already. Most of the time, right, what you probably want to aim for is about 20%. Okay, 20% chance of hitting the stop lah. Okay, so 20% is actually fine. In fact, 20% is like 20% probability is like 11% down. So I can actually shift my stop loss a little bit lower lah. 11% down, somewhere here. Okay, maybe 164. Okay, next, let's take a look at the high to low. If you add in the high to low, right, it can become a little bit tricky. So we have the current high here already. This is the current low, okay? So from a high to low perspective, what is the chance of First Solar hitting our downside target from a high to low perspective? Downside target this month. By the end of June, what is the percentage of First Solar going all the way down and hit 164? So we are looking at the high to low line, meaning from here all the way until this high. About this is 29% now, okay? So when you measure high to low, right, always measure from the bottom up, 29%. So let's look at the high to low probability. High to low probability, 29%, right? 29% is somewhere here, okay? So what we want is 29% and higher lah, okay? We don't want 29% and lower, because 29% and lower meaning we are hitting the lower. So because we are looking at this as a stop loss, right? We want 29% and higher. So the chance of First Solar hitting the stop loss, which is 29% and higher, right? It is actually about 40%, okay? 40%, because this is in the 60 percentile. So 100 minus 60 is 40%. So there's a 40% chance that First Solar will actually return 29% or higher, okay? From a high to low percentage. So from a high to low perspective, right? The probability is a lot higher. From close to close perspective, the probability is a lot lower, mainly because what can end up is that it can actually go and hit here, but it can end up recover and close at that level. Okay, so now let's take a look at it from instead of looking at the current month, right? Let's say we enter at 184, and in the next 1 month, going forward, okay, in the next 1 month going forward, 1 month from now, the day after we enter, what is the chance from a high to low perspective? What is the chance of us hitting this stop loss, which is only 11%? So meaning to say that the candle open like this, the monthly candle open like this, and then it hit all the way down, hit our stop loss. So this is the high, this is the low, okay? But whatever happened after, we don't really care lah. If hit the stop loss, meaning we are out already. So what is the percent? This is so for high to low, right, we have to measure upward. It is about 12.5%. So 12.5% is actually here. So if you look at it from a high to low probability, right, it is quite easy to hit. In fact, it is going to hit 94% of the time, okay? If we look at 1 month from the day we enter, there's a 95% chance that it will actually go all the way down and hit this point lah. Okay, meaning to say that in terms of high to low, right, the chances of hitting this stop loss is very, very the probability is very high. But we must not forget something, because high to low, right, it is both downside and upside, okay? Meaning to say that if we look at this 12% high to low movement, there's a 94% chance because we are looking at 12% or higher lah, okay? 12% or higher, meaning 100 minus 6, meaning 94%. So there's a 94% chance that First Solar can actually move 12% or higher from a high to low perspective. That 12% it can be 12% towards this downside, or it can also be 12% towards the upside, which is somewhere around here. Okay, so meaning if it recovers back up, right, then there is also a 12% chance that it can actually move all the way back to 210, okay, from the entry level. So for high to low, right, it actually looking at both sides. So now let's look back at the close to close. Let's look back at the close to close. So now here, right? Sorry, not close to close. Let's look back at the high to low. Okay. So in this case, right, we can actually see from a high to low perspective for this current month. Okay, for this current month, from a high to low perspective, there is a 29.5% chance. If this is the low, meaning to say that if First Solar go all the way down here, then this is the low. Then because the high is already established there, right? Then that is the current high. Okay. So from our downside target to the current high, right, it is 29.52%. So 29.52% is somewhere around here. So there's actually a 30% chance of hitting this level within June. But this 29%, right, as I mentioned, it is high to low. But it can also be that, what if First Solar actually recover all the way from here, then this become the low, and then you actually have a new high. So that is also a high to low, okay? Meaning that there is also a 30% chance that your high to low is your First Solar, the monthly candle actually recovering back all the way back up to top. But once again, right, all these percentage, it doesn't account for technical and fundamental. So given that currently right now, if you are looking at the current monthly candle, it is actually going down. If we look at the daily candle, if we put up all the momentum indicator, the momentum is definitely towards the downside. Okay, so from that momentum perspective, right, of course, if we consider the high to low, it is much probable that we are actually looking at this. We're actually looking at this probability rather than this probability. Okay, so that's how you look at the high to low and the close to close. So now let's set up a target level. Okay, so let's say this is our upside target, 233. Let's say 232 okay, 232 is our upside target. Okay, so this is our upside target. So let's say you enter now, right? Let's say you enter now. And then you didn't hit the stop loss within this month, okay? Because the probability of this current candle closing at 164 is actually quite low. So the probability of the close to close, meaning from last month closing to the current month, 19% downside, right, is actually quite low. 19% downside is here, 10% only. There's only a 10% chance that you are going to hit this stop loss for this current month. It's actually quite low. But it can also mean that once this month is over, right, within the next month it go down some more and then it hit your stop loss. Okay. And when that happen, right, definitely you will want to exit, mainly because you have one monthly rate candle that is going downwards. And then in order to hit, right, if within this month you didn't hit the stop loss, and within next month you hit your stop loss, right, it means that most likely you are getting like 2 consecutive rate candle in a row, 2 consecutive monthly rate candle in a row, meaning to say most likely there's something wrong with your fundamental, or you may want to recheck a bit. If you look at majority of the candles, right, if you are hit with a 2 monthly rate candle, right, it is a sign that you are going to see a substantial downside. Okay, so if you are hit with 2 monthly rate candle in a row, you enter right now, your stop loss hit at 164, it's highly likely that the fundamental may be not correct, or maybe there is some new information coming in, or there's some new macro driver that's coming in which make your original fundamental invalid, and then definitely, of course, you want to exit. Okay, so most of the time when we are entering long position, right, what we usually want is we want to enter at the base of the green candle, meaning at the support level, this kind, or we want to enter at like the breakout or somewhere at the breakout of the last monthly green candle, okay? And then we will have another monthly green candle, and then we get the momentum upside. But in oh shit, I can I remove all the. But for this case here, right, we are seeing a little bit of sideways movement happening here. You have green candle, red candle, green candle, red candle. But of course, if your fundamental analysis is correct, if things are very bullish and the price start to turn right, then of course you may get another green candle. And if that's the case, right, your entry here is a very, very nice entry level. You got all your upside target, all your downside target, everything just nice now. Okay, so there's a reason why we are looking at monthly candle, mainly because if you are wrong for the month, right, it is highly unlikely that you can recover lah, okay? If worse yet, if you go and buy here and then you set your stop loss and you hit your stop loss somewhere, right, then it is highly likely that your stock is going to recover and also hit your TP level. It is quite unlikely lah, because we are looking at 20 to 60 days our training time frame lah, okay? So that's the reason why we are using monthly distribution or return time frame. And the moment you hit your stop loss, right, you want to be out already. Okay, so now let's look at our upside target. So we have our stop loss here ready. So once again, right, let's take a so for the upside target, let's say if we enter at the current price. So let's say this candle, this current monthly candle, it kind of closed here. Let's say it closed there, okay? It closed very near the current price, and then it will continue to go up. So that is about 25% upside. So once again, right, we want to look at what is the chance of hitting the 25% upside from the distribution of return. So if we look at it from close to close, right, 25.79% upside, it is somewhere around here. It is at the 91 percentile range, meaning there's only 9% chance, 100 minus 91, that you will hit the 25.58% return within a month. So going from 1 month forward from the day that we enter, there is only 9% of the price going all the way up and then close there. But once again, right, this is close to close, close to close. But when we talk about TP, right, it is the same as stop loss also. We are not waiting for the price to close. The moment the price hit the target, we are running ready. So meaning to say, the moment it goes up here, hit, we will run ready. We are not going to wait for the stock price to like retrace back or whatever. So we look at the high to low also. So from a high to low perspective, right, high to low perspective, we are looking at 25.79%, 25.79 somewhere here. So from a high to low perspective, right, there's actually a 50% chance of you hitting that target within the next month from a high to low perspective. So if let's say this is the low for the next month, then the high is this, then you actually have 50% chance. But the chances of it closing there, right, it is only 9%, much lower, because it can actually go all the way up and then close lower. Okay, so there's a 50% chance within the next 1 month. So this is something that we can work with, because our trading duration is 60 days, right? 60 days meaning we are looking at about 2 months plus, okay, 2 months plus time frame, meaning to say that if the stock start to recover, if the stock sort of bottoms and recover from here, right, we have 50% chance of hitting this target within a month, but we are giving it about 2 months time, okay, meaning to say that we have quite a good probability of hitting the target. And at the same time, right, if we calculate the stop loss from this side to the downside, right, to the current downside here, even though the chances of hitting this downside is very, very high, right, if we hit the downside, we are looking at 2 monthly red candle in a row already, meaning to say that we want to be out anyway lah. Okay, so this is actually a okay stop loss, so we can treat this as our downside target, and we can treat that as a upside target from the current price level lah. Of course, in actual trading, right, you will want to wait for all the momentum to come in first also. So in this case, right, let's sort of return back to our volatility appraisal, the ATRP that we are using. If we look at the ATRP, right, you can see that the ATRP is actually 11%. The weekly volatility is 11%. So if we use the ATRP, it falls very nicely within our ATRP level also, 11% downside and 25% upside. 25% upside is about a little bit more than 2 times this one now, okay? But it is somewhere there also. That's why we use ATRP, because it is more of a shortcut method. But if you use the ATRP, right, it doesn't give you the probability of you hitting the target or your stop loss now, okay? In this case here, right, you have 50% chance. You know that there's a 50% chance of hitting your 25.79% upside from a high to low perspective. Okay, so this is actually how we can use the distribution of return in order to work out our probability for target upside and downside here lah. Okay, so now let's use all this data, right? And then we look at it from playing options. So let's try to use the data to structure the options. Because when you structure options, right, option has the expiration date. Okay, so because option have an expiration date, right, you actually have a cutoff date. So with the distribution of return, right, you can kind of work around the cutoff date and to see whether you can get some credit here and there, those kind of stuff lah. Okay, so now let's plan a trade setup. Let's actually plan a trade setup. One thing I want to highlight is that whether you are going to get a winning trade, losing trade, whatever, right, it is driven by your trade idea. Okay, it is driven by the quantitative and the fundamental that you are actually doing lah. So you don't just simply use the distribution of return and then you have 50% to hit here and then you just like go and enter like that. you also need to ensure that your technical is also aligned, price momentum going up, all those kind of stuff lah. Okay, so now let's take a look at first solar. Let's structure a trade. So let's say current price, this is the current price. Current price is at 183, 187, 183 like that. Okay, let's just put a round number, 183. Okay, maybe 184. Okay, so this is our entry level. Okay, now so let's look at first solar. So now we can work out a calendar spread and see what is the chances of hitting certain price level lah. Okay, so in this case here, right, we are looking at call options. We are looking at call option, and then let's use this as a target. Let's use this as a target, as in 212 lah. Okay, let's use this 212. So let's buy the 212. So we can set for August expiration, and then we buy the 210. There's no 212, we buy the 212. But now since we are doing a calendar spread, right, we are writing an options lah. Okay, so we are going to write the 21st July lah. Okay, the 21st July option, and then we will write, let's say lah. Okay, let's say we write the 212. Okay, we can actually write 212. Okay, never mind, we just write the 210. Okay, so this 210, right? It is actually expiring in 21st July. So just nice 21st July is like 1 month from now, okay? 1 month from now. So just nice our monthly volatility, we can use the monthly volatility. And when we look at option expiration, we are looking at closing. We don't really care within the next 1 month how high it can go, but we are actually looking at closing. So the close to close data is actually quite useful here for option also. No lah, August not near. August not near. August actually 2 months from now. Our holding time frame is only our holding time frame is 20 to 60 days, which is one to 2 months lah. Okay, so most of our trade will close within like 30 days like that. So we are not really looking to hold like very long. We are not looking to hold more than 3 months lah. Okay, so in this case here, right, let's see what is the probability of us getting this premium 210. Okay, what is the probability of us getting this premium, which will expire on 21st July? We need to say what is the chance that First Solar will close below 14%. If I enter here in the next 30 days, First Solar need to close below 14%. Okay, so now let's take a look at 14%. 14% is here, 14.27, which is nearer. This is 14.14. Okay, so 14.27. So there's only 10% chance of us hitting this now. Okay, there's only 10% chance that we will hit this from a close to close perspective. Okay, so we can actually use this as our, we can use this as a calendar spread. Okay, so I'm going to buy the August 210 call, sell the July 210 call, and it is highly likely that I will get the premium for this. Then what is our target? So now let's set our target. Okay, let's say our target is at 231, 232. This is our target. This is our sell call. Not sell call, this is our strike price. Now 232. Okay, this is our upside target profit. Because we are dealing with options, right? We don't need to care about stop loss lah. Okay, so our potential target is from 184 all the way to 232. So when we talk about potential target, right, as mentioned, right, once they hit the target, we are going to run now. Okay, of course, from option perspective, right, the option profit may be a little bit different if you hit the target earlier or later, but most of the time, if you hit target earlier, right, your option will actually return more based on what kind of structure you are using lah. But let's just see whether if we can hit this target or not. So we are looking at, yeah, the earning date is correct. Yes, the earning date is actually 27 July 23. So that makes this sell call even better, because this sell call is actually going to expire before the earning, meaning we are not really at risk of suddenly there's a big gap up. I mean, big gap up is very good lah, but it increase our chance of getting this premium lah. Okay, so now the upside target at 232. What is the chances of us getting that 232 target? 26%. 26% upside from the current price that we are looking at. So in this case, right, we are going to look at low to high. Okay, let's say this is the low, this is the high. The moment price hit here, right, we zao already. We are not waiting for closing. We will zao at the high price. So from low to high, let's look at the low to high. This is the high to low, low to high, same. Okay. So from high to low, right, 26% upside is somewhere around here. Okay, just now we look at it already. So of course, it is around 50% down. Okay, meaning to say that actually in the next 1 month, there's a 50% chance that we are going to hit this. But this low to high, it can actually mean the other end also lah. Okay, so it can also actually mean First Solar is going to go down some more next month, and then we hit the low to high at 26. So this is also 50% down. Okay, so make sure you are looking at it from that perspective also. But of course, I mean, if it start to go down like that, right, we will definitely cut the price ready, but we can plan our option trade. Okay, so I will go through how to plan the option trade for you also. So in this case here, definitely this target, right, it is achievable within a month. And let's say if 1 month we cannot get this, we can actually get it within 2 months lah. So within 2 months, 25% upside or 26% upside is definitely achievable for First Solar, because First Solar itself is a very volatile. In fact, for majority of the month, right? For majority of the month, it is moving about 25% now. Okay, so if you look at the highest count, right, the highest data point, it is actually from 10% to 31%. So almost every month it is moving around that amount lah. So that is why we need to ensure that is catalyst present also. In this case, the catalyst is the earnings. But along the way, right, there can be other catalysts like FOMC lah. If not FOMC, maybe there's some news on the tax credit coming out. Those are considered catalysts also. But of course, the important thing is that this target is achievable. Let's say if you put your target all the way at like $280 with an August expiration, then of course this kind of target is definitely not achievable. But this target is definitely achievable within a 20 to 60 day time frame. Okay, so in this case, right, the way we can interpret this is that there is 90% chance of getting July premium. There is 50% chance of getting target price within a month. Okay, disclaimer, this one we are just planning, okay? Or obviously we are not going to enter like this. Obviously the candle like this we are not going to enter. But maybe towards the end of the week we see one big green candle, then of course we will enter lah. But of course we have to update all the premiums, all the value lah, okay? So now, so this is actually quite worth it, I would say. Because we are going to the percentage of hitting this July strike is only 10%, right? There's no reason to do a ratio. We can just do a 1-to-1, and then we can cut down the call price significantly lah. Okay, so now let's take a look at the option leg, this option profile. Let's put maybe bottom is 165. What is our target? Our target is 232. Okay, our target is 232. Okay, so let's look at one contract. Okay, let's look at only one contract. So even though our buy side expire in August, but since our short side expire July, right? The time frame is only until July, okay? So if the price rally all the way until 232, right, you are not going to get a lot of profit, mainly because the short side is going to start to lose money lah. But we have already calculated the probability that the short side most likely is not going to chong above, and the short side will expire before earnings also. So I think it is quite safe for us that we may get somewhere here lah, okay? But anyway, as long as price go up, we are going to profit. So we don't care so much about the upside first. What about the downside? We need to care about the downside. We need to say like you example, you go and enter now, and then the price continue to fall, and then you must have action now. Okay, you cannot simply let this whole thing go to waste like that. Because if you look at the buy and the right, the buy is actually $5.08 per contract. The right is $1.70. Meaning to say on a one contract basis, right, you are risking $388. but you don't need to risk the entire 388 because once you sort of get past your stop loss, right, you may want to sell first lah. Okay, so in this case, right, remember earlier that we actually have a stop loss level at 168. 168. Okay, this is our stop shit. Sorry, stop loss. Okay, this is our stop loss level. 168. Okay, so what is the probability of hitting this stop loss at the end of June? So we are looking at the end of June. So just now we actually calculated before from this buy current price entry to downside is only 9%. So the probability of hitting that by June, right? 9%. Yeah, close to close. The probability of hitting that by June is about 25% lah. Okay, but let's make it 20%. So let's put a stop loss that is 11% down. Okay, so the probability of hitting 163, the probability of hitting this 163, right? It is about 11%. Okay, it is 11% by the end of June. Okay, we are looking at close to close. Hey, so sorry, my bad. It should be from here. Because close to close, we are looking from previous close to the current close to our stop loss. So it's actually 19% now. So sorry. My bad, meaning we can set our stop loss higher. Okay, 18% down now, okay? From the previous close here. From the previous close to 165, right? 18% is somewhere here, okay? So yeah, I was right initially. The probability is 10%. Meaning to say that if First Solar, if it dropped to that level by the end of June, right? Most likely you do not want to be in this trade already, okay? From an option perspective, you do not want to be in this trade already. So now let's look at the option profile. So end of June is somewhere around here, 30th June here. So if you hit like maybe what is the stop loss? The stop loss is 165, okay? So if you hit 165, maybe somewhere around there, by end of June, you are going to lose $224. Okay, you are going to lose $224. It is not your max risk, but you will lose 66% of your risk now. Okay, so most likely by then, right, you want to get out already. You probably do not want to stay in the trade already lah. Mainly because by end of the month, right, if the price is already here, right, then going forward next month, the price actually have to go up all the way like 40% in order to hit your target. Okay, so it is not worth holding on to the trade already, meaning you will probably want to get out of the trade already if, let's say, First Solar drop all the way down there by June. Okay, so the moment your First Solar hit maybe like 168 somewhere around there, right, you should start to plan to run ready lah. Okay, and of course let's say if the First Solar hit 168, right, what you will see is that your short side, right, your short side call only have 7-cent premium left. There's only 7-cent premium left, meaning that there's no point holding on to the time decay on your short side premium already. You might as well close out, and then you still retain $1.30 on your long call. You're still able to salvage that $1.30 okay, which is about $130 based on a $300 risk. Okay, so in this manner, right, you can actually limit your you can kind of limit your loss a lot more. You don't really need to eat the entire max risk, because at that point, right, if at that point you are already hitting this price level that is so low, there is no way for you to recover already. There's no way for you to recover. It's going to take a very, very high amount of price to shoot up, and then the volatility appraisal does not fit into our plausible range ready, because it need like from this point, right? It need like 40% all the way to the upside. So you don't really you can't really get the profit lah. It might be even hard for you to get out at break even. So here, right, we set up our plan. If price hit like 168 ish exit, okay, the risk is 100 and what's the risk? The risk is about $200, $200 like that. Okay, the risk is about $200. Let's put it at $220 lah. Okay, the risk is about $220. So now this is actually our risk. Okay, so now let's take a look at the best case scenario. Okay, the best case scenario is within the next 1 month, you get the premium on the call, you get the premium on the June side call. Okay, so when you get the premium on the June side call, right, what's going to happen is that your overall if you get the June side call, right, your buy price will get reduced by 170 lah. Okay, meaning to say that price is below 210 by July, you will get the June side call, and then after that it continue to rally towards the target. So in this case, right, your buy price, your actual buy price is actually 5.07 minus 1.70, which will give you $3.34. $3.37. Okay, so if you get the June premium, right, you'll get about $3.37. So now let's take a look at what happened after the July expire. So in this case, right, let's just look at a simple long call. Okay, so in this case, I will modify this because if the June one expire, right, we are only paying $3.37 now. And let's put this range to 330. Okay, so if this go all the way to our target, sorry, 232, my bad, 235. So after the July expiration, right? After July, so we only look at after July onwards now, okay? Before July, it doesn't count because we have the short side. But if you are able to get the July option premium, right? And then it continues to go to rally to like all the way to our target 232. So the probability is there. The probability to get to 232 is about 50 percentile within a month. If we give it 2 months, right? With the proper technical, with the proper catalyst, we should be able to get to 232. So if we get to 232, right, somewhere around here, our profit is about $2,000, $1,009, $2,000 lah. Okay, average somewhere around there. So our profit actually is about 1,009 like that. average lah, okay? Profit is about 1,009 like that. Okay, so now if you look at this structure, right? If you take a look at this, you are actually risking $220 for a potential profit of 1,009. Meaning to say that this is actually giving you very, very close to 1:10 like that. Or currently it is about 1:8 lah, okay? Meaning to say that, I mean, if currently right now, if I have, let's say, for example, right? For example, let's use some lot sizing example lah, okay? Currently my account is, let's say, 120K US. So let's say you normally I will risk about $3,000. So $3,000 is actually that's normally how much I risk. So let me just calculate the percentage. Okay, 3,000 divided. This is about 2.5%. Okay, but the thing is, because the risk to reward ratio is very high, right? I can actually like keep taking this kind of trade, and I don't have to like have a 50% winning rate. Even if I win 1 out of like 4, right? I am still up very, very high. And that's the reason why for all the past trade, right? You only need one very good winning trade in order to give you that very, very big profit that comes in your way. But let's use this particular trade setup as an example. Even though usually I will risk about $3,000, but maybe because I am looking at this trade, it is like currently going downtrend, but I also like the current premium. This current premium is quite okay at the current price, or the premium that we have calculated. And I also quite like the probability that I'm seeing. So I want to enter, but the technical not really aligned, but somehow I want to enter lah. Okay, I feel that the fundamental is good. I have very strong conviction on my fundamental. I think at this point it can U-turn whatever, right? So the thing is, shit, where's my so the thing is, I don't really need to risk the whole $3,000. I don't really need to risk the whole $3,000. I can actually risk just $1,000. Okay, so let's try to upsize the lot sizing. What happens if we sort of increase our contract to get the $1,000 risk? Okay, so I will enter a partial position here, maybe with a initial $1,000 risk. So in this case, right, I'll probably enter 4. I'll enter 4. Maybe 4 a bit high lah. I'll enter 3 lah. Okay, so in this case here, right, I will enter 3 contract first, 3 calendar spread first, and it is not a ratio calendar. This is a 1-to-1 calendar. The reason why it is a 1-to-1 calendar is because the price momentum is going down, and not only that, the probability of hitting this is very, very low. And on top of that, you add the momentum going down, right? I think there's no need. It's highly likely that I can get this premium. I don't need a ratio. Normally we do a ratio when we foresee the price to suddenly chong up. Okay, so in this case, I can get away with a 1-to-1 ratio. So in this case, right, I'm going to risk $1,000. So now this $1,000, right, it is my maximum risk. If let's say the price hit around 168, I'll be only losing like $600, $600, $700 like that. It's not even $1,000. So maybe I can increase my risk a bit, okay? I'll increase back to 5. So if I increase the risk to 5, right, you can see my max risk is 1,006. But obviously, I'm not going to risk the entire 1,006. If the price go down to 168 by end of June or early July, right, most likely I will zao already. I will run with the 1,000 and $1,110 risk already, okay? But what if, let's say, the price suddenly go up? Let's say if the price suddenly shoot up to like maybe 2010, for some reason, there is a sudden catalyst came in, okay? There's a sudden catalyst just come in, and then the price just shoot all the way up, like one big green weekly candle, green weekly candle coming. So if that happens, right, what's gonna happen is that maybe somewhere around here, right, it suddenly shoot back to 210, right? Maybe our the moment I see the price action coming in, meaning to say the momentum is now getting better. So when the momentum get better, right, I will add another 1K risk on top. Okay, I'll add another 1K risk on top. And after that, I will see how the price goes lah. Okay, so that additional 1K risk on top, it will sort of further my profit even better lah. But in this case, right, let's say I am able to get the premium by July expiration, I'm able to get the premium. If not, I'm already out of the trade. I will take the 1,200 loss, which is like 0.3% or maybe 0.87% of my total risk, which is fine. I mean, you work out for your own capital, but it is something that is very minimal, okay? Because we are trying to bottom pick this. We are trying to jump into this trade, mainly because we like the premium, we like the fundamental, we like the low price. We want to add a bit of starter position. Okay, so in this case, right, I will add the starter position and then I'll just let it be, let it run. And let's say if my starter position goes well, right? If my starter position goes well, and it goes all the way to 232, I can actually get $9,000. I can actually get $9,000 on an initial risk of $1,000 alone. And in this case, right, I am not even risking like a significant amount of my portfolio. And from there, right, I can actually compound some more. If let's say the price continue to go up, I can restructure my price here and there. And mainly, right, if you are able to get the July expiration, and if the price continue to go all the way up, right, what I can do is that in the second half, after July second half, I can actually do a vertical spread, meaning I can sell the 236 call option in order to get more profit, okay? Because by the time the price hit 236, right, I am already like 11K in profit on a $1,000 risk. So I don't mind capping my profit there by selling some call option there. That is perfectly fine also. But the thing here is that most of the time, right, when you are playing option, you will get a lot of small losses here and there, but that one trade that you are able to win, you'll be able to push it to a very, very high level. So in this case, right, I mean, if I can simply go in right now, I just risk the $1,000. If it is gone, then gone. But that one time that it hit, right, I'm going to get about 10 times return. Okay, and based on all the probability that we have sort of calculated, right, we are the probability of hitting 232 is actually quite okay, quite fine. But let's say if you want to wait for this to U-turn first, that's fine also. And if let's say this price U-turn, right, the momentum is in your direction, then you want to go in, right? Then in that case, you don't need to risk $1,000 like me, small. You can kind of like straight away risk your usual 2%, 3%, that kind of amount. You can actually kind of go in with that amount. So in this kind of situation, right, it is like, if you ask me, I don't scared hit stop loss. I am not scared like the trade goes wrong. I mean, it goes wrong, then go wrong, because I'm only losing a very small portion. And if I am risking like maybe only $1,000, 1,000 of my portfolio is probably less than 1%. I actually have like maybe 100, more than 100 tries I can do this over and over, and as long as one of them succeed, right, it is going to give me that 10 times or maybe sometimes even more lah, if you are able to get the if you are kind of able to sort of get the vertical spread after your July expire lah. Okay, so that's the kind of thing that options allow you to do. For example, let's say you have a stock position, right? You enter here, you enter here, you don't really have any downside protection. You enter a full position here, or if you enter a smaller position here, right? Then yes, if it goes down, you lose small, but in that case, right, if it start to go up, right, then you have to add also lah, okay? You have to consider adding your position also. But if let's say if we just do a simple trade like this, right, you are risking 10% and you are going to get back 26%. Meaning to say that if I put in about 10K position on this, right? If I put in about 10K position on this, I'm actually risking, I'm actually kind of like risking 10% of the position. I'm only getting back a bit lah, okay? So from a risk reward perspective, it is not really attractive, but option allow you to skew that risk reward all the way to the upside lah. So another thing that you can do is that let's say, right, let's say price go all the way up to 210. Okay, let's say price go all the way up to 210 within July, and then you got this profit, and then I mean, even at this level, right? Even at this level, this profit is considered very, very good already, lah. Okay, mainly because you are risking about $1,000 like that, you are getting about $3,000 plus in return. So if you get that profit, right, you can actually run with this profit. You don't need to hold your position if you don't want. You can run with this profit, but you can restructure your trade again with a portion of this profit, meaning you can take out 2,000 from this 3,006 and then you restructure your trade towards the upside again. But of course, by then it is already at, the price is already at 210 lah. Okay, but the thing is that you actually have a lot of options available when you are doing all the option trade. There's a lot of choices available for you. And for example, right, the next choice that you have is, remember, I'm planning to risk about 3K from the beginning. Okay, and let's say price go all the way down. Okay, price go all the way down, and then I hit my loss. I cut my loss. I take about $1,000 loss now. Okay, I take about $1,002 loss, and then after that, the momentum start to come in. So my original risk is 3K, and then I lost about 1.2K. I'm still left with 2.8K. So when the momentum comes back up, right, then you can enter that second round again. You can take this 2.8K, you risk another 1.4K more, you enter again. And if this one works, go all the way, right, then you are going to get about 10K return from this. So that 10K return, right, you will earn back your 1.2. And then not only that, you are probably going to get you get a lot more profit on top of that lah. But the thing is that, but the best part is that if you cut first here, right, if you cut here, and then if you just eat your loss there first, and then when price start to recover, right, obviously your target here is not going to make sense really. Okay, obviously your 323 target is not going to make sense really, because we are actually looking at a much more substantial upside. But what you can actually do, is, since the price is a lot lower, you can structure with a different strike price. You can actually buy 180 and then you target 210. So from there, right, you can see if you look at high to low perspective, it is still achievable, but you will still get about 8-9K profit even if the price go to 211. But if you blur hold your original trade here, and then you put all your risk in your original trade, you hold your original trade here, then what you end up is that even if the price recover up substantially, right, you are still going to lose a lot of premium. Then maybe if you are lucky, you break even, you don't lose money. But if you are sway, right, the price recover sideways, and then your premium gone now. Okay, so by spreading out your risk into many different positions, it allows you to chase your sort of like enter your trade even when the price action is something like this lah. Okay, or if you are trying to chase the price, if it's going up, you can also enter smaller portion. So you can play around with all these kind of lot sizing, and of course work out your distribution of return to ensure that your target is actually achievable. And the reason why we want to exit when price hit here, right? When price hit around 178, 170, it is because by then, right, the profit is unachievable already, because it is already 35% upside. And 35% upside from that point, right, it is a bit hard, and your premium is like all gone already. So you might as well exit and enter a new position again. So the important thing here is that firstly, right, for option, don't be scared to lose. You play small, don't be scared to lose, and make sure that you plan ahead. You plan your structure in a way that when you win, right, you are actually going to win very, very big. And secondly, right, if you have all your fundamental stuff right, even if you have 1 win 4 loss, right, at the end of the day you are going to come out with a big win lah. Okay, and lastly, please don't blindly follow the Patreon stuff. Okay, because on Patreon I cannot guide the Patreon folks, because all of them have different portfolio, different lot sizing, different stuff. I don't know what I mean, on their side I don't know what they are doing also lah. Okay, so on your end, right, you can always plan and double check your position with me, to double check your lot sizing with me, because you can push it a lot further. For example, my Celsius trade, my there are some other trade also, like for example Celsius trade, Home Depot trade, right? It is because I'm doing all this, right, I can actually push it. But if you are just like blindly following, entering, right, even if the trade move, you are not going to get much now. Okay, so work it out, plan ahead. At what level am I going to run? At what level can I chase? Or if I'm going to chase, whether I should split out my risk, is it better or not? Those kind of stuff lah. Okay, so in fact, actually I want to do Steel Dynamic also as a short side example, but Steel Dynamic I will go through maybe next week lah. Okay, so next week we will have another session again, next Wednesday, same timing, and we will go through a similar exercise, but we will be looking at the short side. So we will be using Steel Dynamic distribution of return. And if you want, right, you can go ahead and do your distribution or return for Steel Dynamic and try to plan it out yourself to see what kind of trade can you take, and then to see whether you can get this kind of risk reward ratio or not, whether you want vertical or calendar or whatever lah. Okay, try to plan the whole thing out and see whether if you can get your TP level within a reasonable mean in a way that the distribution or return is telling you, okay, you can actually achieve this TP level realistically. You are not setting the TP level too far out, because when I was looking at STOD, right, holy crap, Nasdaq now 1.27. When I was looking at STOD, right, there's a reason why we exit earlier. Okay, there's a very, very good reason why I exit earlier. Number one reason is I don't want to eat into Carpenter Tech profit. But secondly, right, if you are holding the option, it's better to salvage the premium, because all the way at that TP level, right, you are not going to get the downside already. Okay, you're not going to get 18% downside already. So now, right, you can work it out monthly. Okay, so monthly, very, very simple. I'll give you a head start. Your stop loss can be here. Your stop loss can be around 122. And then you go and work out what kind of calendar spread, what are the TP level you want to play. So for calendar spread, right, it's a little bit tougher to plan out your calendar spread. Maybe your calendar spread can be at, your sell side can be at 92. Work out what is the 92 downside. Okay, work out the probability. But since this is the short, since this will be your short put, right, your long put cannot be at 92. Okay, because if your long put at 92, right, it is too far off from the current price already lah. Okay, if your long put is also at 92, your target actually need to be very, very far down in order to profit lah. Okay, so you go and work out where is your long strike will be, long put strike will be, but your short side you can also, in from a probability perspective, you can go and play around also, and then you try to calculate at what price you want to exit, at what price you want to run to salvage the premium, and then how do you want to work out in terms of your total capital. I mean, if you come to me and you tell me, okay, my total capital is like that, I'm planning this size, I will keep that kind of information confidential. Okay, I won't go around tell everyone about what is your what kind of capital are you playing, but go and play this out. Steel Dynamic is actually quite okay also, mainly because right, you actually have, oh shit, sorry, STLD. You can play calendar also. Calendar spread the same one that I show you with First Solar, okay, but the strike price you go and work out. So Steel Dynamic is okay to play mainly because you have the same expiration, okay. There's a August expiration and there's a July expiration. Okay, there's an August expiration, so it's exactly like First Solar. You can buy the August and then you can sell the July, and then you try to work out what is your max risk or whatever lah. Okay, and we have the July earnings coming out is on the 18th lah. Okay, but in this case, right, since the July expiration is 21st, your sell side will actually run into this lah. Your sell will run into this earnings, but of course, I mean, if you look at the distribution of return for Steel Dynamic, right, because it has such a big data all the way until 1997, right, all the data is already inclusive of earnings. Okay, there will be some months with earnings and then your probability already accounted for it, so you can still use the distribution of return data to see what is your risk reward will be like lah. Okay, so for this kind of trade, right, what we are basically trying to do is that we are trying to enter somewhere at the top of the green candle, and we hope that we can get 2 more red candle down, or even 1.5 red candle is also fine lah. Okay, mainly because if we try to enter here, right, it is highly unlikely to get 2 more red candle, like 5 red candle in a row, 5 red monthly red candle in a row, maybe a little bit unrealistic lah. But at this point, right, since it has already gone up a bit, get resisted, it is quite realistic to get 1 more red candle, maybe 1.5 red candle like that, and you can still achieve your TP quite easily lah. Okay, so go and play around with it. You can come and find me if you want to sort of double check certain things, and of course, if you are going to enter the actual trade and you are not confident, always come and find me also. Please find me on Discord so that I will reply you immediately, especially if you are going to enter a trade. Okay, so that's basically about it. I will upload the distribution or return Excel sheet and go and play around with it. And in the future, right, if you are coming for, if you are trying to come get the one-to-one mentorship, right, we are going to use that a lot. Okay, we are going to use the Excel spreadsheet a lot, meaning to say that you will be refrained, you will be banned from using the ATRP. You will always be using the distribution of return Excel spreadsheet lah, mainly because it is a lot more accurate, and since most of the trade will be taking will be options lah. Okay, and of course, later towards the end of the year, you are coming for the option cost, right? That distribution or return is very, very important for picking out the strike price for all your short options. Whenever you do a vertical, whenever you do a calendar, you want to try to sell something, right? That short side, you need the distribution or return to kind of see what is your probability is like. Okay, guys, so that's all. Thanks for coming. Thank you.